Hey guys, it's Akeem here and welcome back to another video. Now I figured that it's about time that we looked at the fintech company that is PayPal, particularly given the fact that over the last month the stock has fallen by as much as 20%, and when you go back as far as 6 months, the stock has fallen in half. Now we all know that growth stocks are being absolutely hammered, but we're not talking about a meme stock here. We're talking about a $185 billion company that's grown its revenues, grown its profits, and grown its free cash flows. So naturally people are asking the question, has this presented a buying opportunity? And if we buy at today's prices and hold for the long term, will we see an outperformance against the market? Of course, to determine all of that, we need to look at the fundamentals and run our own valuation. So without further ado, let's get into the video. Now, just before we jump into the financials of the company, I want us to take a brief look at the stock chart. Now, of course, the stock chart should never dictate any of your investment decisions, but I think this does make an interesting point. And the point is this, right? So PayPal came to the stock markets in 2015 when it was spun off from eBay. Now, I think the most interesting thing about this is that this has been a fairly steady grower and a fairly steady sort of compounder over a period of time until we get to COVID-19, right? So it was $120 pre-COVID. We then had the sort of crash, the mini crash that we experienced in March. And from there, the stock has been absolutely parabolic. So whenever that happens, you always have to ask the question, is there been a reason to justify this, insane increase in valuations? Because this growth here is not driven by fundamental changes to the business. It's actually just driven purely by market multiples. People are now willing to pay more per dollar of revenue or per dollar of earnings for this stock than they were prior. So always bear that in mind, that whenever you see a significant rise in a stock like this, there's always the probability the valuations have actually gotten too hot. And as a result of that, we see the decline of 50% thereafter. But let's jump into the financials. So the first thing that I want to show you, of course, is top line revenue growth. So in 2016, we were sitting at $11 billion. That has increased to the end of 2021 at $25.3 billion. Now, we haven't actually had their full year results yet, but we have had 3 quarters of those. And in Q3, management came out and said that they're expecting somewhere between $25.3 and $25.4 billion. So ticker terminal right here, I've got that absolutely spot on. For 2022, management have come out and said that they're expecting somewhere in the region of around 20% revenue growth. This figure here, which is an analyst estimate figure, is slightly below that. But by and large, we're looking at $30 billion, $31 billion for 2022. So they continue to grow at around 18 to 20% year over year, and they have done that consistently. So that's obviously very good to see. Now, very quickly moving on, we can see that EBITDA is also increasing at very similar rates. So we're looking at $2.8 billion in 2016, right the way up to $7.3 billion for 2021. Now, with that being said, and with that growth taken in mind, this is not a cheap company. So at the end of 2022, we're expecting net income of 6.2 or $6.3 billion. When we go to look at the valuation of the business, we're talking about a business with an enterprise value of around $180 billion. So that's a forward PE ratio of somewhere in the region of around 30. Now, that might feel like a very normal market multiple, and over the last year or two, that has been fairly standard. But actually, when you go back further, you start to understand that the markets at the moment are very, very hot, and people are willing to pay very high multiples. And we're starting to see a reversion to the mean over the last 6 months or so, which is why you see a lot of these growth stocks that have absolutely fallen off a cliff as they revert back to their mean valuation multiples. And that's illustrated quite nicely by this chart here, which shows PayPal's forward PE ratios over the last 5 years or so. So prior to COVID-19, we can see that the average was around 30, 32, and then following COVID-19, it went as high as 67. So it looks fairly obvious that this is not a standard market multiple to pay for this type of business. And as a result of that, we now start to see these valuations come back down to earth. And now it's sitting at around 32, which is actually round about the average what it was before COVID, which might suggest that the business is fairly valued, but we need to get further into the details to understand that. But it wasn't just the wider macroeconomic environment which sent PayPal stocks lower. So we can see here that PayPal tumbles after cutting full year sales and profits forecasts. And there was a drop in volume from eBay business, which was accelerated in the 3rd quarter. And we can see that transactions tied to eBay's marketplace slid 45% in the 3rd quarter, a bigger decline than in the previous 3 months. And PayPal said in a statement that PayPal has been battling the loss of eBay ever since the two decided to end their long-term partnership in 2018. So as a result of that agreement with eBay coming to an end, we've seen a slowdown in the growth in total payment volume for PayPal. And as a result of that, investors are getting concerned that they aren't going to be able to replace the business that they got through eBay. And as a result of that, total payment volumes are going to stagnate, and therefore revenues will also stagnate over the long term. Now, management have been working very hard in order to counter the loss of transaction volumes through eBay, and as a result of that, they have actually signed an agreement with Amazon with their payment processing or the payment mobile app Venmo. We can see here that teaming up with Amazon to enable customers in the US to pay with Venmo at checkout. Starting in 2022, customers will be able to make purchases on Amazon.com and the Amazon mobile shopping app using their Venmo accounts. Now, Amazon, I don't need to tell you, is a business that generates revenues of around $500 billion per year. So clearly, if you manage to strike an agreement with Amazon, I think that there's a huge amount of potential there. And I would actually argue that eBay is going downhill whilst Amazon is only growing. And as a result of that, I don't necessarily think that this is a bad transition. I think that it's going to take some time, but over the long course, I do think that this will be beneficial to PayPal. And the fact of the matter is that a deal like this simply would not have been possible had eBay and PayPal still had that agreement together. And we can see that Dan Schulman, the CEO of PayPal, said in an interview that the Amazon deal is an incredibly meaningful part of Venmo's monetization journey. And the deal was the result of PayPal no longer having the restrictions of the eBay operating system. Now, don't get me wrong, Venmo is still a very, very small part of PayPal's business. So we're talking about PayPal that has revenues in the region of around $23 billion. And out of that $23 billion, Venmo is on track to deliver $900 million of that. With that being said, it is a very fast-growing part of their business, and we're finally expecting it to be profitable this year. Now, despite the significant decline in eBay's marketplace payment volumes, we can still see that total payment volumes for the quarter in Q3 2021 were $310 billion. So that is absolutely huge, with 416 million active accounts. Now, clearly this is a key driver, and it's something that we need to pay attention to if you're looking to invest in this type of business. Total payment volumes will always drive total revenue growth. So now the total payment volume from eBay marketplaces accounts for just 3% of PayPal's total payment volume versus 7% a year earlier. So there has been that absolutely huge decline, but that's not necessarily a bad thing, right? And the reason I say that is because when we look at the revenue growth excluding eBay marketplaces, that was actually 25%. So that is significant. And I do believe that over the long term, the amounts of payments that they process through Amazon and Venmo will be much larger than their current total payment volume that they're seeing through their eBay marketplace. And that growth excluding the eBay marketplace is actually illustrated really well here. So we can see that it was $100 billion in Q3 2017. And 4 years later, they've managed to multiply that by 3 up to $300 billion. So this is a very fast growing business if you don't take into account the fact that they've lost this agreement with eBay. And considering the fact that eBay now only represents 3% of their total payment volumes anyway, it's not a material part of their business. Now, PayPal's balance sheet is very good as well, and there are certainly no concerns of any liquidity issues in the near term. So we're looking here, and they've got cash and cash equivalents of $8 billion, and they've got short-term investments, so think treasury bonds, of $5.5 billion. So we're looking at around $13.5 billion of effectively liquid cash. We go down to their liabilities, we can see that they've got long-term debt of $8 billion, and that is pretty much it. So they don't really have much else other than that. So they'll be able to take that cash and pay off all of that debt if they wanted to, but of course management don't believe that that makes sense, particularly given the low interest environment that we are currently in. So then that brings me onto my valuation model for the business. So we can see here that for 2022, I'm expecting for revenues of around $30 billion, which is a growth rate of 19%. And actually this is just taken from analyst estimates. In terms of why I'm comfortable with using those estimates, we can see that management have said that if you look at their business for 2022, excluding eBay, they expect their revenue growth to sit at around 22%. Therefore, 19% when you take into account that they're losing sort of business from eBay appears to make sense to me. I think that's a reasonable growth rate. Now, for 2 to 5 year revenue growth, I've gone with 16%. Now, in terms of my rationale for that, we can see that if we look across the historical period, they tend to grow somewhere between 15 and 18%, with the exception of 2020 when they had a very strong year. So I think anywhere between the region of 15 and 18% would be a fair estimate. And I also think that management have come out and said that they're aiming for revenue growth in the region of around 19% over the medium term. Considering we're looking at 19% for year one, I just want to be a little bit more conservative and go with 16% thereafter. Now for years 6 to 10, we're looking at revenue growth of around 12%. Now the reason for that decline is simple. As businesses get larger, it's more difficult for them to grow. And with PayPal in particular, they're already capturing a fairly large amount of the market, right? But as more competitors enter the space, they are going to have to reduce their transaction fees. So despite the fact that they may be growing their total payment volumes, their transaction fees are having to come down. And that is already evidenced within their results. So we can see here that total payment volume for Q3 grew at 26%, but actually their revenue growth was 13%, which shows that despite the fact that they are acquiring more volume, right, they're processing more volume, the transaction fee or the clip that they're taking on each of those payments is having to reduce compared with the prior year. Now, in terms of operating margins, we can see that these have been fluctuating over the historical period. So it was 16.8% in 2017. That fell down to 14.4% in 2018, where it has then been put in the growth thereafter. I think that a margin of around 18% seems fair for this business, and I actually think that we are reaching maturity. With that being said, I've gone for 18% up until 2025, and then 19% from 2026 onwards. That means that over the next 10 years, their revenues go up by almost a factor of 4, where we see their revenues increase to $96 billion from $25 billion. And similarly, their net income increases from $3.9 billion to almost $15.7 billion. Now, in terms of the weighted average cost of capital, we're sitting at 9.8% for this business, and that's just a function of that calculation there, so we won't dwell on that too much. Cash and cash equivalents of $13.3 billion. Now, for total debt, I've got $9.7 billion because this includes operating leases as well. Now, in terms of the discounted cash flow, we can see that their EBITDA margins have actually remained relatively stable across the historical period with an average of around 20%. I'm actually expecting those EBITDA margins to increase ever so slightly up to 23%, but I'm expecting it to remain relatively stable thereafter. Unlevered free cash flow as a percentage of EBITDA, I've gone with 75%. And that's just slightly below the average because if you take into account that this is a bit of an anomalous year, we can see that actually the average over the last 4 years or 4 out of the last 5 years sits at around 75%. So I think that that is fair as well. That gives us a fair value according to the DCF of $126 and a fair value according to a multiple of earnings in 10 years time of 20 of $105. In terms of the rationale for 20, well, this is a business that has historically traded at a relatively high multiple and therefore a higher multiple, even though it is in 10 years time, is probably expected. With that being said, we are expecting that the business will have just been growing at 12% per year over the last 5 years, according to the inputs of this model. So it's hard to try and rationalize anything higher than a P ratio of 20. That gives us a fair value per share of around $116, which means that at the current price, it's still around 26% overvalued if you agree with the inputs of this model. With that being said, if you wanted to value this business based on a 2026 enterprise value to EBITDA multiple, then you're looking at 2026 EBITDA of around $12.5 billion. I've applied an enterprise value to EBITDA multiple of 18, which I'll rationalize in a moment. We're looking at a 2026 price target of around $205, which again would only be a return of around 5.5% per year, which at the current price means for me, it's simply not worth an investment at this time. Now, in terms of why the enterprise value to EBITDA multiple of just 18, given the fact that actually multiples currently are much higher than that, again, the rationale comes back to the fact that by the time we hit 2026, we're expecting that revenue growth is only going to be around 12% going forward. Now, you have to ask yourself, what multiple would an investor be willing to pay in 5 years' time when a business is only going to be growing, according to the inputs of this model, at 12% per year? I find it hard to be able to attribute a multiple any higher than 18, despite the fact that this is a very solid business. They have a very good moat and a very good brand, and I think that they'll be around for many years to come. But I still find it hard to believe that they are going to be able to grow at rates high enough in order to justify a multiple any higher than 18. Anyway, guys, I hope you've enjoyed the video, and until next time, thank you.